Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, U.S. stock futures pushing higher this morning on the last trading day of the second quarter and the first half. The past quarter and 6 months have been volatile for financial markets, but ultimately, stocks powered to new highs. Investors are now looking ahead to the headwinds facing them in the second half of the year. Just 10 days to go until President Donald Trump's country-specific tariffs are set to resume if we don't see some deals come forward. Plus, the tax bill front and center for investors after clearing a key procedural hurdle in the Senate over the weekend. The Senate will now kick off a marathon voting session on dozens of amendments today, a process that can take 12 hours or more. And Senate Majority Leader John Thune will be working behind the scenes to sway 8 Republican senators who have voiced opposition to the bill. And investors will also closely be watching the June jobs report that's due out this Thursday for the latest read on the labor market. Economists expect 113,000 jobs to be added in the month in this report, slightly lower than the prior read of 139,000 jobs. A weaker report could fuel bets for the Fed to cut rates sooner rather than later. Let's get a check on stock futures here this morning as we're taking a look at the U.S. major averages here. Let's pull those up for our viewers at home. As you see them on the bottom of your screen, and you can see them right behind me. We are higher across the board as of right now. Fractional gains for the Dow, the S&P 500, and the NASDAQ this morning here. As we're taking a look at those fractional gains, we've got a lot on deck this week, even an abbreviated trading week. Let's turn to some of our top stories of the day. Stock futures higher as we head into the final trading day of the first half of the year, with the S&P 500 and the NASDAQ at record highs. And in Washington, the Senate is convening to debate President Trump's major tax bill. The president wants the legislation on his desk by July 4th, and a looming tariff deadline coupled with the upcoming June jobs report. What it all means for the Fed's rate cut analysis. Joining me now, we've got Ali Canal live from the NASDAQ, Inez Ferre, and Jennifer Schonberger here with me. So, Ali, let's start with you on those record highs that we're watching.
Well, as you were just laying out, Brad, we're seeing green across the screen in futures trading. So if these gains hold, we could see an extension of that rally, another record high potentially for the S&P 500 and the NASDAQ composite. So it feels like there's a lot of optimism being priced into this market, a lot of resiliency. However, there are some cracks underneath the surface. For example, the performance gap between smaller and larger cap stocks in the S&P 500, that's back to its widest level since July 2024. So that means market breadth is narrowing, aka those bigger cap stocks, they are once again strongly outperforming your smaller average stocks. So when you have that sort of narrow leadership, that leads to a more fragile market. So we're going to want to see a bit more market breadth there, which we have seen, but some fraying at the edges. And then another crack that stood out in my inbox this morning is I've been receiving a lot of commentary from Wall Street strategists about their mid-year outlooks, what they're expecting in the future. And I have to say that most of the commentary that I've gotten, it's skewed pretty bearish. Raymond James saying that the economy is on weaker footing than markets believe. In regard to Fed cuts, Morgan Stanley said a cut in July or September is actually a bit more unlikely than markets are pricing in. And markets so far over the past week, they've doubled their odds of a July cut. Meanwhile, RBC's Lori Calvasina, she called out a tug of war between growth and value in the year ahead. They're actually overweight value and cyclical, notably financials and now materials. So a bit more defensive in nature there. And then finally, BNP Paribas said that slowing consumer demand is a key concern. They cited declining retail sales, soft Q2 personal consumption trends as a key risk to earnings going forward. So after this blockbuster first half, there is this cautiousness around what the second half of the year could bring. It's all going to come down to that economic data, what we see on the jobs front this Friday, and then, of course, earnings, which are right around the corner. And Inez, I know that you're watching Bitcoin.
Yeah, that's right, Ali. Bitcoin right now hovering above 107,000 per token. And it is really shaping up to be a banner year for Bitcoin as we close out this first half of the year. We are taking a look at the token that's up about 14% year to date. Since President Trump was elected last year, though, it's up about 50%. And by the way, Bitcoin's share of the total crypto asset market is now at 64%. There's a lot of momentum behind the token, of course. There's a shift going towards a more regulated industry. You had earlier this year President Trump signing an executive order for a Bitcoin strategic reserve. You've had a crypto czar, a crypto-friendly SEC chair. All of this has been very bullish for Bitcoin, not so much for for altcoins, so to speak. So you have seen, this is a year-to-date chart on our Yahoo Finance Interactive, and you can see Solana down 22% year-to-date, Ethereum down 26% year-to-date. So it's really Bitcoin, the one that has gained quite a bit. And taking a look at gold, because we are also watching some of the commodities right now, gold has also seen a bit of a pullback. It's right now hovering at around 3,294 per ounce. But gold has faced a pullback in recent weeks. A lot of this has to do with easing of geopolitical tensions and also signs of progress in the global trade war. Nevertheless, you are seeing that year to date, gold is up about 23%, Brad.
All right, thank you, Inez. And we also know that all eyes are on Washington this morning as the Senate convenes to debate President Trump's tax bill. Jennifer, you're down there in Washington, D.C. What do we know?
I am down in the swamp, Brad, and Senate Republicans are gearing up for a final vote, finally, on this big, beautiful tax bill as Republicans are trying to rush to meet the president's self-imposed deadline for July 4th, this Friday. And they ended up advancing the bill by a very slim majority over the weekend, actually losing two Republican senators, Senators Rand Paul and Tom Tillis. This morning, the Senate will kick off what is colloquially known as a vote-a-rama, a series of votes in which senators can offer amendments and vote on those amendments. The price tag on this bill really setting up an interesting debate in the Senate because it has gone up to $3.3 trillion, according to the Congressional Budget Office, and that compares with $2.4 trillion from the initial House bill that was proposed. Already over the weekend, we saw some fiscal hawks in the Senate bulk, and Vice President J.D. Vance had to do some arm twisting there with hardliners like Ron Johnson and Cynthia Lummis. So that sets up an interesting debate for today. Once the Senate finally does get over that hurdle, whether it is today or not, the bill will then head to the House, where again, I think there are some question marks because we know there are many fiscal hawks in the House as well. But I will say, Brad, there is nothing like a deadline for Washington to try to get things done. And with President Trump and this July 4th deadline on Friday looming, lawmakers could actually get to the finish line by then.
Jennifer, a couple of other things to watch as well. President Trump says he doesn't expect to extend that July 9th tariff deadline for nations to secure deals with the U.S. And the jobs report we know is due out this Friday. So what does this all mean for the Fed's thinking around rate cuts?
Yeah, well, it certainly doesn't help the case for uncertainty, right? We know that the Fed is very much in a wait and see mode. And, you know, I wonder if the president is kind of trying to use a negotiating tactic here in the final 10 days to try to push for more concessions from other countries, right? We saw with Canada, Canada decided to relinquish their digital sales tax that was supposed to be imposed today, buying them more time to negotiate with the president. Europe trying to do something similar on the military side, perhaps with purchases of American weapons. So I think we still need to see how this unfolds. If, in fact, the president ends up issuing letters that have definitive tariff rates, then the Fed will get some certainty on whatever the effective tariff rate will be, and that will help them navigate policy. I don't think that we're going to find any clarity in the next 10 days yet. And you mentioned the jobs report that due out on Thursday this week because markets are closed. The government is closed for the July 4th holiday. That expected to show some cooling for the third month in a row. 113,000 jobs expected on the top line, with the unemployment rate ticking up a notch to 4.3% from 4.2%. So some more gentle cooling there. We know that Fed Governor Mickey Bowman has said that she is is more concerned about the employment side of the mandate than the inflation side. So given the inflation report that we got last week, which saw a little bit of a mild uptick, but if you looked at whether it contributed whether tariffs, I should say, contributed to inflation, it was rather nil. So if we continue to see these job reports come in cooler, then that could be enough to sway Fed Governor Bowman and perhaps Fed Governor Waller to vote in favor for cutting rates come July. But for the rest of the committee, I think the rest of the committee is more hawkish, and they are still going to be stuck in a wait-and-see mode. So I think it's going to be fall before we have any clarity here, Brad.
Yeah, and Allie, I want to come back to you because it's clear that the market is starting to enhance its thinking around what this average effective tariff rate could be, and especially knowing how far into the future markets look. It seems that this 10% range is what investors, what some of the largest firms as well, have been comfortable trading around with that in mind.
Yeah, and that's come down significantly from what we saw around Trump's Liberation Day tariff announcements in April. Since those deals have started to trickle in, we have some sort of framework with China. There is a good faith effort that will be signed. We seem to have some progress there with Canada. But, you never know what President Trump is going to do. And I think there's that taco trade element of things as well, where this has largely been seen as a negotiating tactic and that we can get these trade deals done. So that seems to be one tailwind for the market, that there is progress on trade. That was probably one of the biggest unknowns around the spring. And although there is a lot of uncertainty, we have yet to see tariffs fully work their way through the system, work their way into the data. There is at least some sort of clarity around what Trump is willing to negotiate for. So when it comes to peak uncertainty, I think we're beyond that point, and that ultimately is what the market is hanging their hat on right now.
All right, Jennifer, Allie, Inez, thank you all so much for taking the time breaking down these stories with us this morning. We'll continue to track them throughout the rest of today's trading session and this week. Well, the S&P 500 notched a fresh record on Friday, and with futures higher, it could continue to break records on the final trading day of June here. But how did we get here? That's the big question. The index, it came into the year strong, fueled by Wall Street's enthusiasm for President Trump's election, but there were several key moments that sent stocks up and also retreating as the first half progressed, culminating in the index's fastest ever recovery from a 15% drop. And so take a look here at the chart and the pathway that you've seen. On your screen, you'll see a few of those key moments. One of them that I want to zero in on to start off things, because this is where we ultimately were starting to get a sense of where there could be cracks in this AI trade because of the elucidation of some of the competition overseas, especially within the realm of DeepSeek. But what took place thereafter, especially after we were already watching some of the declines and the pullbacks in two of the most favorite stocks in Wall Street? Oh, yeah, namely NVIDIA, and then, of course, another key barometer in Apple. Those were leading some of the pullbacks early on in the start of the year. DeepSeek worsened that, but then we ultimately did see a rebound as NVIDIA started to come out and Jensen Huang essentially saying, no, this is actually good for our business and for some of the competition that would essentially on the app side still rely on chips, which are the base level of the AI thinking and the broader stack that investors have been considering in terms of the applications sitting on top of the language learning models that then sit on top of the chipset, where NVIDIA was quick to pound the pavement and say, no, this still means more demand for us. So you see a rebound and we go into February, notch some new all-time highs. However, this is where the market needed to start to really begin thinking about what President Trump, who had then been weeks in office talking about, was what the tariff policy could look like here and the composed or uncomposed chaos that ensued. And so in all of that messaging, one of the key dates that was laid out by the administration was the Liberation Day, as it was dubbed. April 2nd, those tariffs announced, and the sweeping move ultimately sent stocks cratering here. You took a look at what we had seen in the declines and the precipitous drop into that and throughout that next week. But this is another key day that investors will remember, and this might become known in history in some form as Taco Day. The the chicken out trade, if you will, as we saw the reversal of some of those Liberation Day tariffs and the fastest ever rise and recovery that then ensued thereafter. Now, here's also what is key, because now we were in a position of wait and see for some of the deals that would begin coming through. Oh, yeah, by the way, in the backdrop, we were also moving through an earnings season where companies had to either pull their guidance in entirety or update and revise. And that takes us into some of the FactSet data where we'd seen tariffs become the most mentioned common denominator on earnings call over the course of the season. So with that in mind, it became known that we would need to still wait and see what types of deals would come forward, U.S. and China being the chief most between the world's two largest economies. And so May 14th, U.S. and China reciprocal tariffs were paused. However, there's still more to net out in some of the details of a deal going forward. So even with a truce in mind, we've still continued to see markets trend higher, but the larger question that's still being mulled on the street right now is this melt up right now actually one of the biggest risks going into the back half of the year? And that is something that time will tell. Coming up on Morning Brief, we count you down to the opening bell on Wall Street as stocks close out the first half of the year. We've got much more ahead. Now time for some of today's trending tickers. We are watching wind solar stocks, HPE, and Moderna. First up, solar stocks reacting pre-market after the latest version of the Senate's tax bill added a surprise new tax. The duties would apply to wind and solar projects completed after 2027 that use certain components from China, the industry's primary supplier. In addition to the new tax, the draft bill would phase out tax credits for large-scale wind and solar projects by the end of 2027. That's earlier than in previous drafts. Next up, Moderna says its flu vaccine shows positive late-stage trial results. The new data would enable Moderna to offer a single shot that protects recipients from both COVID and the flu. Back in May, the company faced a delay in the review of its combo COVID and flu shot from the FDA. Moderna's head of research and development told CNBC the company plans to resubmit the application for the combination vaccine and file for approval of its standalone flu shot later this year. And finally, the U.S. Justice Department has settled its lawsuit alleging server maker Hewlett-Packard Enterprise's acquisition of Juniper Networks for $14 billion, according to court filings. The department sued to block the deal in January, arguing that it would stifle competition. Executive editor Brian Sozzi spoke with HPE CEO Antonio Neri about the deal last week. Here's what he had to say.
Our view is that we believe this is pro-competitive. We believe this is good for enterprises. Remember, we don't support consumers. And ultimately, we believe we will prevail in court if we have to go all the way there.
HPE and Juniper said the terms of the settlement clear the way for the planned deal to close. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Senate Republicans are racing to pass a sprawling tax cut and spending package with a final marathon session underway Monday. In its current form, the bill would add nearly $3.3 trillion to the U.S. debt over the next 10 years, according to the Congressional Budget Office estimates. Joining me now with more, we've got Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director. Jennifer, good to see you. Thank you so much for taking the time here with us pre-market. Just take us into your assessment of the additive cost that this tax bill, based on estimates that are floating around, would ultimately mean for the economy and how investors should be thinking through that.
Good morning, and thanks very much for having me on. You know, this is not a shock that we're going to be seeing trillions and trillions of dollars added to the bottom line. And in terms of what it means for the economy, this is, not great news for the economy. I mean, at the same time, everyone's watching ever since, Moody's took away that final AAA rating. There's have been a lot more eyeballs on the U.S. fiscal deficit side of the page, and foreign investors are looking, and domestic investors as well, seeing how much the U.S. is able to rein in their spending, how much control they have over their spending, and whether or not they are able to do so. And if they can't, obviously we're going to see debt to GDP rising, deficit to GDP, interest payments rising as well. And then, of course, this means ultimately longer-term yields on the higher side, and that means higher borrowing costs for consumers in terms of credit cards and mortgages and auto loans and all that sort of stuff. So, broadly speaking, not good news for the U.S. economy longer term.
What's that read through, do you think, for the Fed, if that means that the costs for consumers, essentially at the end of the day, for being able to take out or get loans for very high ticket purchases or even high equity purchases, things like homes, especially as the Fed is reading through the affordability crisis for the housing market right now. What is the Fed's assessment here if this is a longer term implication?
Another headache for the Federal Reserve, clearly to think about. But right now they are more focused, I think, on the here and now, what's happening with the economy, what's happening with the labor market. We're going to get a glimpse of that later on this week. And of course, what's happening with the read-through of tariffs on inflation. And it makes their job, Fed Chair Powell's job, much more difficult in terms of how to move going forward. We are, by the way, still looking for a couple of rate cuts this year, starting in September. If I had to lean in a certain direction, if I had to say there was a risk, there may be a risk that they may be waiting a bit longer. Again, waiting to see what the fallout of tariffs will be. So again, also another headache for the Federal Reserve and especially for Fed Chair Powell.
Jennifer, I wonder how you and your team, as you were mentioning the impact of tariffs and what that could potentially mean for inflation, I wonder how you and your team are running the calculus or any modeling around what the anticipated average tariff rate could be and what it needs to be in order to do what the Trump administration has been saying in terms of the tariffs countering some of the costs of this tax bill.
That is a very difficult one to model. Because we've never been through this sort of situation before. But ultimately, you will have to think that this is going to have some sort of inflationary impact, which is going to slow down consumer spending. We started off the year at 2%, a 2% average effective tariff rate, went as high as 26%, the highest in over a century. And now we're down to about, I think it's like 15, 16% or thereabouts. So we're still roughly 8 times where we were at the start of the year. So that is going to have that sort of inflationary impact. We're still waiting for that to flow through. I've been a little bit stunned, quite frankly, that we haven't seen it come through yet. But I think there are a number of factors in play as to why that is the case. But Fed Chair Powell also sort of gave a little bit of a time frame, I think, last week when he said we have to wait a couple of months to see what the impact of tariffs will be. So I think he said summer, late summer or something like that. So I think September, we're still pretty comfortable with for now.
We know that consumers are at least thinking increasingly about tariffs, as well as that was one of the leading write-in responses with little change since May in the most recent consumer confidence print from the Conference Board. All that considered, consumers are also thinking about job prospects and the employment situation. What is your assessment of where we sit right now and what we could potentially be looking for in this coming monthly jobs data once it gets released later this week?
Okay, so a lot there. So right now for jobs data, we are also looking for a cooling in the job market, about 120-ish thousand jobs for the month of June. Looking for the jobless rate to probably tick a little bit higher to about 4.3%. Again, still very low, broadly speaking, and there's still demand. But, we've been, from the clients that we've been speaking to, everyone's sort of sitting around waiting to see what happens with the tariffs. There's the question, are they even legal? What level are they going to end up at? What percentage is going to be and what certain sectors is it going to be? Are we going to see like a 10% baseline tariff on everything? We just need to have some certainty. But because we still don't have a lot of certainty just yet, although we are starting to get there, I think consumers are also very cautious about this. As you mentioned, they're concerned about jobs. They're concerned about inflation, although inflation expectations have ticked down. But I just have to say this, that latest report that we saw on Friday for May PCE, obviously the headlines were a bit jarring when we saw the decline, but it was interesting that when you look at the different components of what people were spending on, they weren't pulling back on everything. That would have been more worrying, but they were still spending on discretionary areas like discretionary goods and services, cars, pulling back on dining out, but still, I think that's kind of meaningful that, they're still comfortable enough to keep spending on discretionary areas.
Jennifer, always a great pleasure to get some time with you. Thank you so much.
Thanks.
That does it for us on Morning Brief. Opening Bid is next on Yahoo Finance.